My old car was a beat-down Toyota Solara, and my accountant calls me up and he says, Jaspreet, I think you should get a new car. In fact, how do you feel about G-Wagons? I said, they're nice, but I don't know if I should buy one. He says, well, I think you might want to reconsider that. And the reason why is because Section 179 says that if you buy a vehicle over 6,000 pounds for your business, you deserve a tax break for that. Now you might say, well, how does a G-Wagon relate to my business? And what he said is that because I am an influencer, I can make a claim that in order to maintain my status as a social media influencer, I need to drive around in a G-Wagon. And this can qualify for a certain amount of tax break on my taxes. Now, I didn't go out and buy the G-Wagon because I didn't feel like it was a smart purchase for me. I wanted to keep my money in my bank account and use the money to continue growing the business. But you can start to see now how you can start to use the tax code to your advantage. In 2024, according to Section 179, if you get a vehicle that weighs over 6,000 pounds, such as a G-Wagon, you can get up to a 60% deduction in year one. Let me show you what the math looks like. You are a social media influencer, meaning you post pictures of your life on Instagram and you are making $100,000 a year, hypothetically. Now you walk into the Mercedes-Benz dealership and you see this $100,000 G-Wagon sitting right there that you want to buy. And in order to buy this $100,000 G-Wagon, you then put $20,000 down. This is not financial advice, I'm just showing you how the tax code works. So you put $20,000 down to go out and buy this G-Wagon and then you finance the other $80,000. Well, if you qualify for this full 60% deduction in year one, that means you get to take a $60,000 tax write-off against your $100,000 income. So you tell the IRS, hey, I have $40,000 worth of taxable income, even though you have $80,000 in the bank. Because remember, you had $100,000 of profit, you put $20,000 down in the G-Wagon, you have 80 grand in the bank, and then you take a $60,000 write-off, meaning you can pay taxes on $40,000, even though you have 80 grand in the bank. Now, in order for any of these deductions to work, you have to show the IRS how and why this expense qualifies for a tax break and why it qualifies as a business expense. This is where having a good accountant comes in handy, because if you do it wrong, you can pay penalties, fines, or end up in jail. So get yourself a good accountant, because they can help you, number one, identify the good tax breaks, but then also help you qualify for the good tax breaks. This is what tax strategizing is all about. And if you have a bad accountant, that's why you want to start looking for a good accountant who actually helps you with tax strategizing, which brings us to number two. Depreciation is a paper write-off. That means you get to take a tax break on your tax bill on paper, but it's not an actual expense that you have to pay out of your bank account, and real estate investors love this depreciation tax write-off. So let me show you how it works. Let's assume that you go out and you buy this $1 million apartment building. It's a commercial building, an apartment building, and you bought it for $1 million. The first thing that you have to do is separate the value of the land from the building. So I'm just going to assume that the value of the land is $200,000 and the building, this thing right here, is valued at $800,000. The reason why is because you cannot depreciate the value of the land, but you can depreciate the value of the building. Now, when it is a commercial building like this, what you do is you take 1/39th of this value. So $800,000 divided by 39, which is $20,500 a year. This is how much of a tax break you get every year for 39 years of you owning this property, just because you own this building. What the IRS says is because this building is 1 year older, you deserve a $20,500 a year tax write-off, even if your building is going up in value. Let me show you now what the numbers look like. Let's assume that this building pays out a 10% return. It's paying out $100,000 a year in profit, just to keep the numbers round. Now, normally, if you have $100,000 a year in profit, you have to tell the IRS you have $100,000 in profit and you have to pay taxes on that, but not here, because don't forget, we have depreciation. Because your building is 1 year older, you get to take a $20,500 write-off. Again, this is a paper write-off. You're just telling the IRS that you want this deduction, even though your property might be worth more money next year. So now you're only going to have to pay taxes on $79,500, even though you have $100,000 in your bank account. But that's just the beginning. This is the standard depreciation that you qualify for when you go out and you buy a commercial property. It's 1/39th of the value of the building. If you're buying single family homes, then it's 1/27th and a half of the value of the building, not the land. You don't qualify for this when you go out and you buy a home to live in. You only qualify for this as a single family or a commercial real estate investor. But if you have a good accountant, you can get a little bit more sophisticated, because what you can also do is you can accelerate the depreciation and take bigger tax write-offs earlier in the deal. If you want to get a little bit more sophisticated, what you could do is a cost segregation analysis. And what this means is somebody's going to walk through this property and they're going to say, this is the lifespan of your plumbing, this is the lifespan of your flooring, this is the lifespan of your walls and other things in the property. That way you can qualify for specific depreciation models for different parts of the building. That way you can accelerate your depreciation. So let's go through a hypothetical. What this means now is, instead of going for this standard $20,500 depreciation a year, you're going to start off with much bigger depreciation amounts. You might be able to go out and say, I'm going to depreciate 20% of the value of the building in year one. The value of the building is $800,000. 20% of that is $160,000. That means you have $100,000 of income from rent. This is your profit. If you can do this cost segregation analysis and potentially depreciate 20% of the value of the building, you take a paper write-off of $160,000. Again, this is just on paper. This is not an actual expense that you have to pay, which means you tell the IRS, hey, I have negative $60,000 worth of income, even though you have $100,000 in the bank. Now, this is where things get even more interesting, because what if you have a job and you have an income? You might be able to take this loss and attribute this loss against the income, depending on how much money you make. Or what's even easier is, if you have other passive losses, if you have other real estate properties that are making you profits, you can take this loss and put it against that. But let's assume that you don't. What if you work a job? Can you take this passive loss, because your real estate income is considered passive income, can you take this passive loss and deduct it against your active income? Well, let's take a look at what the IRS says. If your gross adjusted income is $100,000 or less, you may deduct up to $25,000 of rental losses. Above $150,000, you can't deduct anything. So if your active income is low enough, you might be able to take a piece of this paper loss and deduct it against your active income, lowering your job or your business income as well. If you enjoyed this clip and you want to continue your financial education journey, I have another video that I think you'll love. All you got to do is click that button right over there. And for those of you who want to stay up to date on the top finance and business news, you can join Market Briefs, my free financial newsletter, by clicking that button below. Thank you for watching, and I'll see you in the next one.